Ladies and gentlemen, let's be honest about something most people still don't want to admit. In an economic war, nothing is off limits. For decades, the United States has perfected financial warfare, sanctions, dollar dominance, capital flows, and above all, interest rates. On the surface, interest rates look boring, technical, innocent, just a tool to fight inflation, right? Wrong. Interest rates are one of the most powerful weapons ever created, and the Federal Reserve itself admits this. When the U.S. hikes rates, whether by 50 basis points, 100 basis points, or a full percentage point, the pain doesn't stay inside America. It spreads across the planet. Emerging markets get crushed, currencies collapse, capital flees, and GDP in vulnerable economies can drop up to 0.8% within 3 years. That's not theory. That's data. And that's exactly why between 2022 and 2024, the world erupted into one currency crisis after another. China, Europe, Africa, Latin America, their currencies fell off a cliff, inflation exploded, imports became unaffordable, savings evaporated, and ordinary people became poor almost overnight. This wasn't an accident, this was financial gravity, weaponized. But here's the twist. Today, America is trapped. Donald Trump can't use financial warfare the way the US used to. Why? Because the tariff war backfired, and now, the strongest pillar of American power, the dollar is cracking. Since April 9th, the dollar has been sliding hard, down against the G10, down against emerging market currencies. This is catastrophic. A falling dollar doesn't just mean higher domestic inflation, it means something far worse. Global investors are losing faith. Why buy US bonds if the currency itself is bleeding? Why park your money in America if your returns are wiped out by FX losses? Trump didn't just weaken the dollar, he shattered one of America's greatest advantages, a strong currency that attracts global capital. And here's where things get really ugly. The textbook solution to a falling currency is simple: raise interest rates, higher rates attract capital, higher yields pull money back in, the currency stabilizes, but the US can't do that anymore, because America is drowning in debt. Debt to GDP is now well above 120%. Annual interest payments are over $1.2 trillion. That's 4% of total US GDP just to service debt. That's insane. There is zero room to hike rates. Raise them too much and the US Treasury collapses under its own interest burden. That's why rates don't just want to go down, they have to. And this is exactly why Trump is obsessed with controlling the Federal Reserve. If he doesn't force rate cuts, the debt spiral accelerates fast. So instead, he's chosen the short-term fix. Accept higher inflation, accept a weaker dollar, kick the can down the road.
Even the Fed admits this is unsustainable. The US is on an unsustainable fiscal path. The debt is growing faster than the economy. We are borrowing from future generations.
And here's the real problem nobody is talking about. A weaker dollar and lower rates make it much harder to attract capital, especially for the sectors America desperately needs to dominate. AI, semiconductors, advanced computing. Without foreign money flowing in, China gets breathing room, and Beijing is using that room ruthlessly. That's why China doesn't want Nvidia's latest chips. It's not about performance, it's about denying US tech giants revenue, starve the enemy of capital, force them to slow down. And while the US burns cash on expensive labor, energy, and materials, China stretches every dollar further. Scientists are cheaper, rare earths are domestic, energy is dramatically more affordable. This is asymmetric warfare. And now comes the next phase of the financial battle: capital capture. Chinese chip companies are flooding stock markets with IPOs, AI chip firms, GPU rivals, memory manufacturers, interface chip makers. It's happening at a scale we've never seen before. And investors are piling in. On average, Chinese chip stocks are up 34% this year, double the gains of the broader Chinese market. Every IPO creates hype. Hype pulls in capital. Capital fuels more R&D. This is devastating for the US, because bubbles must grow to survive. If US tech bubbles stop expanding, they don't stabilize, they deflate. Meanwhile, Chinese firms are swimming in fresh money, and because AI and semiconductors are national priorities, that capital goes straight back into research, new chip generations, higher density, lower power consumption. Some Chinese firms have already unveiled chips that boost computational density by 50% and improve energy efficiency by 10x. That's not incremental, that's disruptive. Cheaper data centers, smaller footprints, massive scalability. Cluster enough of these chips together, and suddenly Nvidia doesn't look untouchable anymore. The gap is closing, fast. And Beijing isn't stopping there. Just last week, China announced $70 billion in new semiconductor funding, subsidies, grants, domestic chip independence. And where's the money coming from? Ultra-long bonds. China is issuing debt with maturities of 10, 20, even 30 years. These bonds now make up over 30% of total outstanding Chinese debt. This is brilliant strategy. AI and semiconductor investments take decades to pay off, so China is locking in funding for decades. At absurdly low rates. China's 30-year yield? 2.2%. The US? Nearly 5%. There is no universe where the US can compete with that. If the Treasury tries, the bond market explodes. China can do this because inflation is low, the currency is stable, and investors are confident, so global capital is being locked away in Chinese bonds for decades. Meanwhile, the US survives on constant refinancing, month after month, year after year. In 2026, the US must refinance nearly $8 trillion in debt. Let that sink in. Issuing long-term bonds at high rates is impossible, so the burden shifts to short-term T-bills, which is basically injecting gasoline directly into the financial system. So what happens next? Two things. First, the Fed cuts rates even more to keep the system alive. Second, quantitative easing returns. Money printing. There's no other option. So brace yourselves, inflation isn't going away. Liquidity is everything in this war, and the side that can create the most money without triggering inflation wins. Right now, that's China. China's money supply, usable money, has surged to $16.5 trillion, an all-time high. China now accounts for 1/3 of global money supply, twice that of the US. And yet, no inflation crisis. Why? Because Chinese money isn't chasing consumers, it's chasing production. Factories, research labs, chip fabs, AI infrastructure, same cheap money playbook the US used for decades but executed with discipline. China has become the marginal driver of global growth. They're steering new investment. That's why breakthroughs are happening almost monthly. Lithography. According to Reuters, China has quietly built its own EUV machine, the holy grail of chip manufacturing, built earlier this year, with a team that included former ASML engineers. By 2028, working chips are expected. EUV means 4 nanometer chips and smaller. Once firms like Huawei gain access, we're looking at a flood of affordable advanced chips hitting global markets. This isn't coincidence. China has launched a full-scale Manhattan project for semiconductors. Unlimited research grants. Uncapped salaries for PhDs. Housing and living allowances. Top talent will follow the money, and they are. As one US tech executive admitted, we've conceded that market. They're building the entire stack, and once it's complete, they'll export it. That's the endgame. And here's the brutal truth. We are now in a global subsidy war, and because of America's debt trap, China is winning by a wide margin. By 2030, the US faces a shortage of over 1.4 million skilled tech workers, not because people don't want the jobs, but because education is too expensive and wages can't keep up with costs. China subsidizes education, subsidizes housing, subsidizes research. Unless the US does the same, catching up becomes impossible. Which means something has to give. Massive spending cuts, higher taxes, or full-scale dollar debasement. Print everything, pay for everything, hope inflation doesn't spiral. That's the crossroads. So let me ask you, will China continue pulling global capital away from the US? And will America try to print its way out of this one? Drop your thoughts in the comments below, smash the like button, subscribe to the channel, because the financial war is just getting started. Will China continue pulling global capital away from the US? And will America try to print its way out of this one? Drop your thoughts in the comments below, smash the like button, subscribe to the channel, because the financial war is just getting started.